Hi, this is Anthony Parent, and yesterday on May 15th, 2018, we had a little bit of a tornado that did some damage outside our office over here. And everything's okay, it's just a little bit of property damage. But before this tornado struck, I had the chance to speak with some tax experts, John Richardson and Dave Sutherland, about a different type of tornado. A big, fat, stupid tornado. I'm talking about Section 965, the new transition tax, and how it can really hurt some American taxpayers. Hi, this is Anthony Parent of Parent & Parent LLP, and today we have a very special episode. We're going to be talking about the nightmarish Section 965 tax due that was originally called an excise tax. Now it's just called a transition tax, and I've even seen it called a toll tax. And on the phone with me is John Richardson of Citizenship Solutions, and he's been instrumental in sort of alerting people to what's going on and also sort of trying to get some reform going. And we have a new guest today. This is David Sutherland. David Sutherland is a CPA, and he is in Idaho. Is that right, David?
Nope, it was Montana.
Montana. So close, right? Well, actually, it's kind of far away. Now, I'm looking at your bio here, David, and it says this. You said part of your larger goal is to provide clients with a bridge to sanity in an insane tax-compliant environment. And my question is, did you write that before or after Section 965 was passed?
Yeah, actually I did. That was way before it was passed. and little did I know how much more true it was going to get. I was just talking about some of the other taxes that we've been fighting. I call them by form number, the 8821s. When you have a little TFSA, you have to file a form 3520 and a foreign trust, and then you have to compute tax on these things as mark to market. That was bad enough, but now we've crossed into completely insane.
Yeah, more insane than completely insane. That's about where we are. And John, thanks again for joining us today. And so today we're going to be talking about something kind of specific about 965. And what's that, John?
Well, I think we've got a deadline coming June 15th, and what it means is that people need to make a decision whether to respond to that deadline. And in order to do that, I think they need to know something about what the deadline means, and they need to understand the broader context of this, this particular issue. So we're going to try to, I suppose, review some practical considerations, what to do, how to respond, all that good stuff.
All right. Now, if I was going to, by the way, what we're talking about is a transition tax, and if I was just going to put my label on it, it's basically a tax on the retained earnings of usually a controlled foreign corporations. Would you say that's about accurate, fellas?
Yes.
Okay.
Undistributed earnings.
Undistributed earnings. Very good. So this now, David, you have this is really an issue that you've been running into a lot with your Canadian clients. So why don't you tell us a little bit about what's going on there?
Well, I'm still trying to get my head wrapped around it because I've got so many people that there's going to be a big number. I was just on a phone call with a staff accountant. We spent about 40 minutes trying to guide him through this, and at the end I should ask this question first. So what's the retained earnings that you know about? Oh, it's a negative $1,000. I said, oh my gosh, we're done.
Yeah.
Right? He was worried about fighting it all the way through, and what does this mean, and how do I run the numbers through? And I said, well, we don't have the final number through November, but we're close enough so that it's either going to be a very small positive number or a negative number. Well, if it's a negative number, this doesn't apply. We're done.
Okay, well, that makes it easy. All right, that's one situation.
That makes it easy. So I think I just realized this morning that should be step one before we waste any time talking about it. If you've got a situation where you don't have any retained earning, any undistributed earnings, as John pointed out, you don't have a problem. But if you do have undistributed earnings, you got a big problem.
Yeah, that's right. And we're going to try to work through some of this. Now, this is sort of applying to large and small business owners around the world. And I think one of the things that's lost in Washington, and I think the perspective of most people, is that if you have this very same corporation or very same entity in the U.S., your compliance is very simple. If you have a sole proprietor or an LLC, you could put it on a Schedule C, which is basically just taking your profit and loss. It's not all that complicated. But when you move overseas, typically is that you're doing it in something other than your name, some sort of entity, and now that triggers a whole bunch of compliance. You just can't put it on your Schedule C. You have to do a whole bunch of things. Like, what are some of those things that John? What are some of those things you have to do?
Well, for most people outside the United States who are governed by this sort of stuff, if they set up a corporation, the first thing they would do is see if they can have it treated as a disregarded entity, or at least possibly do that. But in general, the regulations force them into treating it as a per se corporation, and that means that they basically have to file a separate tax return on behalf of the company, and it's all included in what's called a Form 5471. I have no idea why anybody calls it a form, because it's really a collection of schedules, and it's extremely comprehensive and time-consuming. But one of the
John,
things
can I interject just one thing? That 5471, if you look at it, that's a corporate tax return, essentially, that you're burying inside the individual's return. That's how to understand that.
Yeah, that's a good point. Yep, that's right.
It's actually more comprehensive than if you were to file a corporate tax return in Canada. It's quite extraordinary.
Yes, but
it things.
Yeah, it reads like a U.S. corporation.
Now, on the transition tax, so the problem is that many, and I think this is the issue for you, David, is that you have people who are just in Canada. Let's just say someone who is a U.S. person as well. What kind of person is sort of surprised by this Section 965 toll transition tax? What are your calls like?
Yeah, I think they're all surprised by it. In fact, that we knew it was kind of coming, but as you saw, we didn't really even get guidance until April.
Right. Yeah.
And so our first good set of guidance came out right at the end of our tax season. And that's I didn't start diving into this until like the 20th of April.
You mean you didn't have spare time on April 6th when this was published? You didn't have a few?
Yeah, I didn't.
You didn't? Imagine.
I didn't.
Well, what's the typical Canadian client? What's their corporation? What do they do? Why don't you describe who that person would be?
I actually don't have a typical, because I get referrals from a lot of chartered accountants that these are U.S. citizens,
mm-hmm.
and most of them have been Canadian residents all of their adult lives, or maybe all of their lives. They just have to happen to have U.S. citizenship. Well, they've gone about their lives, and like many other Canadian business people, they've formed corporations, and they've been running their businesses through this, obeying the Canadian tax laws, and then over the last few years, it's been publicized enough that they should be filing their U.S. tax returns, because there are huge penalties for non-disclosure if you're a U.S. citizen. So my typical client, it doesn't matter what industry it is in these, has some kind of a small business or maybe multiples. And I've been trying to keep my people out of passive foreign corps at all costs, because that's a whole nother separate calculation where everything's kind of been unraveled year by year.
That's right.
But for the most part, they've been let's say they've had just a business that goes along, and that Form 5471 heretofore, unless you were held to be a passive foreign corp, but if they're running their businesses through there, it shouldn't have been passive. And all this was a disclosure. So I could take a financial statement or a Canadian corporate tax return and throw it on there, and all it did was add some cost to their tax return. There really wasn't any tax bite, nor should there be, because this is all Canadian earnings under Canadian laws, and this wasn't there. It isn't like it's a U.S. resident trying to hide money overseas, which is really what they were after.
Yeah, that's exactly right. And it's not just in Canada, but it's around the world. And so many of our clients, their tax due when they when they hire us to take care of an issue, their tax due on their foreign corporations is the least of their concerns. Very few of them are in a lower tax jurisdiction than the U.S. And so when we apply the foreign tax credit, there's nothing there. But is there a large legal and tax preparation bill due? As I'm sure you probably surprised a few of your clients with they didn't know it was that they didn't know it was that complicated until they got the final bill. And that's
my largest tax client cross-border wise has I start with his Canadian return, and it's about a 1/4 inch thick. So he's got a fair amount going on even in Canada. Well, his U.S. return on the same facts, because I have to report both sides, is over a foot thick.
Yeah.
And I'm not kidding.
That sounds about right to me. That is, right in line with our experience, and I think John's been seeing some of that too. Now, the thing is about this transition tax is it's sort of retroactive because it's all your built-up undistributed earnings over the years. So it's sort of a retroactive tax. Now, I guess this was, according to this, you have to go back to, it's all your post-1986 undistributed earnings. And the reason why it's 1986 is because that's when the last, prior to 2017, the last tax reform was put in place. And by the way, I think it was a much bigger tax reform. So the question is, John, do you have to go back to 1986 to get all your records for this if you were in existence?
No, absolutely not. Well, as long as your business began after 1986.
Okay, let's say mine did begin in 1986. If mine did begin...
Did begin in 1986?
Yeah.
Well, then you'd have a record of your accumulated undistributed earnings, which presumably would be, if they were done accurately, they probably weren't, but you'd find that on Schedule J of the 5471. If you had a business that began in, say, 1976, and we're looking at accumulated earnings up until December 31st, 2017, then I suppose you would need the records because you'd have to subtract the part of the undistributed earnings that were attributable to the period prior to 1986. What that means, I suppose, just thinking out loud, is that compliance is actually probably impossible for anybody business prior to 1986, unless they're the type of person who, has a sort of a tax return collection. Some people collect stamps.
The chances, I don't know. People move and things change.
Tax returns.
Yeah, I don't know. Records. And that's this. People ask me, hey, Anthony, how long should I keep my tax records for? I just sort of breathe. I'm like, I don't really want to give an answer. How long can you hang on to them?
As little as possible.
Yeah.
How about as little as possible? Because at least for the people who, there's no requirement to keep the records, and now they've got a law that makes it impossible for some of them to comply without them. So why not just
in my discussions with a client,
you can always comply with everything.
I have a client that had a business significantly before that, and best of his recollection, he had about $1 million of retained earnings back then, but he has no records on that. So now I've got I have as much as $1 million Canadian that I shouldn't be reporting, but we may have to because we don't have any backup for it.
Well, I don't think that's right. I think that.
Well, what number can we use, John?
Outrageous that I think you simply estimated, and that's that. I mean, you have a defensible estimate.
We're always used to
surely you would not.
The standard is always to the best of our abilities, and sometimes, that's where, guesstimating is the best of our ability. But where you do have the ability to go back and get the actual number, sounds like you're obligated to get that actual number.
Yeah, and the U.S. laws are not retainage for 7 years like we usually tell people. The tax returns are supposed to be saved forever. Great, just store them forever. We're struggling with all of this, and I'm sure we're going to use a number, but we just haven't come up with it yet.
Yeah. Now, the undistributed. Here's a situation. You have a corporation that has not distributed earnings. Okay, it's still in there, and so the question is how can this be taxed to the individual? The individual didn't get the money. So how does this work?
It's fake income, Anthony. We have fake news, we have fake this, we have fake that. And as part of tax reform, they needed something fake, so they said, well, let's make up some fake income.
Oh, jeez. So, right, you're really putting people in a bind.
They used an existing provision called the Subpart F rule. It's an attribution rule.
So your asset could really be a liability. It's basically, that's...
Well, I think in a world that's moving towards supervision of capital and basically capital confiscation, I think your assets probably are liabilities.
Yeah. Now, do you know if this violates any tax treaties, John or David?
I've been asking that question lately, and nobody can give me an answer.
Yeah.
John's blog was the only thing that when I searched for, I said I had a problem with the treaty under double taxation, and John's blog was the only one that was addressing it all at all. The service of the IRS is not addressing it. The tax services on my end are not addressing it so far. I can't find anything out there what we would call that is a primary source that I can rely on. I've even asked instructors of classes that I've gone to, hey, what about this? And I have gotten no answers.
Yeah. And I would say my inbox is flooded with continuing legal education credits for 965 tax. And all of these people are out there teaching people about 965, even though this publication was just printed April 6th for a law that was passed on December 22nd, 2017. So the fact is there's not really any expert on 965, and that includes the IRS. And it seems like they're sort of making this up as they go. It wasn't really a well thought out. I would say this. In theory, it made sense. I think you can actually go back to a place to say, okay, yes, that makes sense. That what you're trying to do is you're saying, okay, we're going to restrict the worldwide taxation of corporations in the future, or we want to move to more of a territorial base. But what we want to make sure is that people haven't abused the system, and therefore, if they have deferred gains, that we can make sure that we can get, here's the cost to it. You're able, if you want to get out of this, you have to pay this transition tax. But that's not how it worked out at all, is it, John?
No, absolutely not. But before getting into that, I would like to suggest that there is, in fact, a primary document with respect to the tax treaty issues, and I think it's actually the tax treaty itself.
I agree.
Which is about as primary as you can get. If you were to look at, Article 10, Paragraph 5, it specifically precludes the taxation of undistributed earnings in this context. And if you look at Article 14, there's an obligation to prevent double taxation and not, in fact, cause it. Now, I would agree that, there are issues that arise because of things like the savings clause and all this sort of stuff. But ultimately, treaties are determined by both parties to the treaty, meaning both governments. And I think it is absolutely incomprehensible to imagine that the government of Canada would have signed a treaty that could be interpreted to allow the United States to simply, by creating a fictitious tax event, come in and preemptively tax Canadian capital, that is the earnings inside a Canadian corporation, prior to there being a taxable event in Canada. In other words, It's just simply outright theft. I mean, you can dress it up with all kinds of technicalities, but it's outright theft. And for that reason, it certainly violates the spirit, and I would argue the letter of the tax treaty.
So you believe it violates the U.S.-Canadian tax treaty. So what's the response?
I think it does. I think people are afraid to make the argument that it does. Okay, and they're afraid to make it for two reasons. The first is that they mechanically respond by saying, well, the treaty contains the savings clause, which allows the United States to tax its own citizens as though the treaty didn't exist. Well, I think there's a couple of answers to that. The first is the corporation itself has a treaty right to not have its earnings taxed, and clearly, in the plain language of Section 965, it's going after the after the undistributed earnings. The second point that I would make is that the subpart F inclusion, that is the mechanism of simply attributing the undistributed earnings to the corporation, is simply a backdoor way of trying to do something that they're clearly not allowed to do under the treaty. So yeah, I would argue that I believe, and I would argue that it does violate the tax treaty. The United States government and the IRS is not the sole arbiter of the treaty.
That's right. There is another party involved there. So I guess that's where. So I think it's more of a. I don't think that we would give a blanket answer to say we're gonna claim a treaty exemption, but that's certainly an argument out there. At least for U.S. Canada, we'd have to examine the other treaties and countries that we have treaties with to determine what it violates. And you're right. I mean, those savings clauses just sort of tend to negate so much of the entire purpose of the treaty. But I guess what's the purpose of the treaty? If this is allowed, it's not worth anything. It's really not worth much of anything.
Well, that's exactly right.
Yeah.
By the way, this provision, of not taxing undistributed earnings, is a fairly common provision in these tax treaties. You'll find it also, I believe, in the OECD model tax treaty. The problem here is this: that what is going on, to put it very simply, is that the United States, by creating a fictitious event, is basically taking a preemptive tax strike, meaning they're trying to impose taxation on something before, say, Canada would do so, and basically removing that capital from the Canadian economy. If there were no timing mismatch, in other words, if it weren't taxing it before Canada could, then what would happen on an actual distribution would be the distribution would go to the individual shareholder who would pay the tax to Canada, and that tax paid to Canada would be used as a tax credit against the U.S. tax owing. And incidentally, these problems arise also in conjunction with the 877A expatriation tax rules.
I see. This is it really goes deeper and deeper when you think about it, and sometimes your head can hurt a little bit too much about it. And I think one of the other things that really hurts our head on it is the timing. Now there was an original due date, I think, of April 17th, but that's been postponed. So June 15th looks like the new date, or is that June 22nd? What's
No, I don't think they actually changed that. What they did was figured out that if you had an automatic extension because you were out of the country on April 17th, then so the date doesn't apply. Let's say if this was me as a resident of the U.S., I don't think that, correct me if I'm wrong, John, but I don't think the June 15th is applicable to me. It's only applicable to residents elsewhere. But here's the problem.
Correct. Absolutely correct.
Yeah. Here's the problem.
I mean, leaving aside technicalities.
Yeah. I always get an extension I always get an extension for all of my clients, and the reason on April 17th or 15th or whatever the date is, because I don't know that they aren't visiting the United States on April 17th, which would technically make their date April 17th. So rather than keeping track of every one of my cross-border clients, I have to get them an extension on April 17th just because I know they're down here on the weekends a lot.
Sure, that makes a lot of sense, yeah.
No,
So
so
anyway, for most of my people, I think we still have that June 15th now, but I'm hoping that that'll get extended because there's too many open questions yet.
and I think you're
What do you think
absolutely
the
right.
basis is for getting it extended?
I have no idea what that would be. I'm in total denial about some of this stuff anyway because I've got at least one person that we can't write that check because he's got all of those retained earnings that the U.S. is after all deployed somewhere.
Yeah, right. There it is. Yeah, there's your
Commenting on
problem.
that, David. One of the things that I think is extremely important to understand about this, and we haven't really touched on this today, I think because it's so obvious, but this is a tax that's not based on any realization event whatsoever. No realization event whatsoever. Normally, taxes are imposed if something is sold, all right, for example, or an income tax. If there's something that you do, some event, something that you can have awareness of and plan for. This is entirely different. This is just United States government looking around and saying, "Oh my God, we see some capital there. We're going to take it." It's no more complicated than that. So you've got a situation where I would think a very large number of people will have absolutely no way to pay this money whatsoever, absolutely none. Because the retained earnings in the corporate and the undistributed earnings, that doesn't mean that they're sitting in some bank account in anticipation of a great 965 confiscation by the United States. As you point out, that money is deployed. It could be in real estate. It could be in all kinds of things. So, yeah, gigantic problem here.
I guess, I was going to save this question to the end, but maybe I'll ask it now. So what, and maybe you can't answer this. So the client that is facing financial ruin, if they comply, what do you tell that person?
I haven't had the final word on that. I don't have anything that I can really tell them is like, write your congressman, but they don't even believe they have one. They do, but it has to go back to this. It has to go back to when they left the U.S. Well, some of them were actually born in Canada, so I don't know who their congressman is, and if they care, because they're not voters. And I would highly encourage any U.S. citizen to find out how they can vote, and get on the rolls, because that brings you up to the status that A, you're entitled to, and B, up to the status of everyone else that can call and whine at their congressman.
Yeah, that's right.
That's what needs to happen.
That's right. There's some great groups out there. There's American Expatriates on Facebook to get it on. And also, if you're looking to vote, we had Kathleen Mystery of AARO on before, and their website, they're right on their homepage. Just go to aaro.org. If you are an American overseas, a dual citizen, there you can learn how to make sure you're registered to vote and vote accordingly. To get to make sure that people know that this is just a new level of insanity. So, John, how do we calculate how much we owe, by the way?
Actually, before we get to that,
Yeah.
I want to tag on to David's answer for the last thing. And this is, I think, extremely important, and I'm not offering this in the form of advice necessarily, but in the spirit of awareness, okay? We're talking about somebody who has no way to pay the tax. We've been talking about treaty issues here, and the simple fact of the matter is that the Canada-U.S. Tax Treaty contains a provision that basically says the Canada Revenue Agency will not help the Internal Revenue Service collect on any tax that accrued at the time the person was a Canadian citizen. So I'm not suggesting that this should be, the front line attack or something, but I do think that for those who absolutely cannot pay, I think it's comforting for them to know that under no circumstances will the Canada Revenue Agency, as long as they're Canadian citizens, assist the IRS with collection, which means that it would be very difficult, unless they have assets in the United States, to collect on that. And this particular type of provision exists in the tax treaties of 5 or 6 other countries, including, I think, France, Netherlands.
Yep, Netherlands. I'm familiar with that one. Is right. That's correct. Yep.
Sorry,
Yeah.
what's that?
Yeah, and I would say, I mean, I can't advise someone as a practical matter that to go ahead and ruin yourself for tax compliance. I mean, the reason why you want tax compliance is so you're not ruined, that you're worried about it. But if you know you're going to be ruined by tax compliance, then how could you do that? That doesn't make any sense to me.
Question here.
Yeah.
Of choice in some cases.
Mm.
It's not even a question of choice. There is no realization event.
Mm.
They're looking at the balance sheet, and let's talk about how this thing is calculated in 1 second. But they look at this and they say, you owe us this money. Okay, the answer is, well, I have no cash to pay that money. I have no way to pay it. You're not choosing whether to pay it or not. You can't pay it. So the question is, what's the position that you take? I don't know. Different strokes for different folks, as they say. But I think that the treaty plays a number of roles in this whole problem.
So on calculating tax, so how do we go about in doing it? I have the IRS publication 5292 in front of me. How to calculate Section 965 amounts in elections available to taxpayers. It's a simple 18-page document.
Just fill out the worksheet.
Just fill out the worksheet, right? And there it is. Look, they even have a table, so a sample table for me to fill out. Wow, this is 18 pages. So where are we generally looking for our undistributed earnings, John and David?
Well, we start with Schedule J on the 5471.
Well, the ones that John, most of my Schedule J's aren't right. Because I start
and because
when,
they're not
when
right,
I get
what
the
do
client.
you do next?
Yeah, I start when I get the client, and I start adding to that Schedule J amount as we go, because I don't know how. Well, in some cases, if it's before 1986, we didn't even start with the number, right? We're just every year we're adding the proper amount to that Schedule J, but we don't know if they've been in business for 50 years. What that starting Schedule J amount really should have been. So I added the proper amount every year, and I know they're not all quite right. If you have those Schedule J's filled out perfectly since inception, then you have a number. But that isn't what we're seeing out there in play.
Yeah, the chances of getting a Schedule J that's right is very remote in my experience. Assuming someone did file something, it's usually not done, and I think that it's done. People are sort of just trying to get something passable. Well, we put some numbers in it, and sure, and it wasn't really any tax due, so it doesn't matter. This is sort of the 5471 is one of the most complicated forms out there that requires so much granular, in-depth information, and I always sort of in the back of my mind, I always wondered, why do they want this level of detail? And now I'm looking at 965 to say, did somebody know? Was this a design? Because really the only way you can get it is if you were doing these Form 5471s correctly. And the issue that we see, I think there's two issues that we see. Just again, just if they filed at all, the chances of it being correct. It's incredibly onerous to go back in time. I'm sure, David, you've had this experience, incredibly difficult. And you're dealing with Canadians predominantly, and a lot of times we're dealing with other countries where records aren't necessarily kept as long or as easy to understand. And now the problem here too I have, and we'll probably touch on this at the beginning, is so many people realized they had a problem. And the IRS roped them into doing a full OVDP. People who had no willful intent just made a honest mistake, and then they went ahead and demanded a 20%, 25%, 27.5% penalty on the foreign assets in the asset base. Now, or maybe the people waited, and then they got a better treatment through the Streamline program where they're living overseas and didn't have a penalty to pay. But now we see the people in the system. The IRS was saying, okay, guys, just sort of get into the system. We want to get you into the system. And now that you're in the system and you did file a Form 5471, Well, it's pretty easy for us to see what your 965 liability is. And I guess, I don't know, do you guys agree with me that this is just sort of the wrong way to get people to comply with the law?
No, I think that this was driven by the U.S. corporations, this law. They like it. This is good for them, because if they want to be pulling cash back to the U.S., this is a lot cheaper than they were facing before. They had a lot of cash parked elsewhere. So, you didn't hear Apple complaining about the tax law, even though they had to write a really big tax check. They liked it. And so this law was written for them, and then somebody got the bright idea, oh, by the way, let's throw even individuals in there that happen to own subsidiaries, basically, is what it was for Apple. And they threw in individuals there. And then they didn't even allow individuals the tax credit. And I'm sure we'll get into talking about that, because I'm sure John will be all over that, how the individuals actually are going to pay more than the corporations unless we make some elections.
Yeah, so John, maybe actually that question...
I think what this really is in its base form is that, you look at the way these laws are made, and, there has to be a way to pay for the law. And the overall goal of tax reform was to get the corporate tax rates down significantly, and I think that was a laudable goal because, the highest corporate tax rates in the world, the country couldn't survive indefinitely. So the transition tax was, I think, more about trying to create the impression of finding a way to pay for this, or at least in part, this tax reduction. If you read like the Wall Street Journal a few weeks leading up to this, and they're trying to figure out or speculate on what was going to happen, there was all this discussion of, well, maybe we'll move the transition tax higher, as they did. So really, to put it simply, what's happening here is that individuals are being screwed so that corporations can have lower tax rates.
Yeah. And it was, this is something that we see time and time again, that these bills get scored in a way that it doesn't connect with reality. And there's never any accountability when the reality winds up being completely different than what was promised. We saw this in 2010 with FATCA, that it scored that it was going to raise about $800 million in revenue. And I think there was a study recently by Professor William Burns from Texas say actually now it's costing $30 million a year in lost revenue. And in addition to that, there's this worldwide tax burden in the billions of dollars that's offloaded to foreign entities. And so the question, so you just have to wonder, as a constituent, you're wondering, they always claim that this is going to raise this or cost this. Should we not invalidate laws then that don't sort of meet their budget expectations? And if they're not meeting their budget expectations year after year after year, then why are we even scoring anything? It doesn't even seem to make any sense, because we get totally out of line and there doesn't seem to be the accountability. I do agree that lowering the corporate tax rate, and this was a good deal for the corporations, but to apply it to individuals is so backwards. It's really terrible. And we also still have to figure out how we calculate it. It's the undistributed earnings. But what does that mean if it's in cash or fixed assets? Because I'm just thinking off the top of my head, if it's in fixed assets, well, you have to sell an asset. And usually, and this is just standard IRS practice, when you're submitting a deal to the IRS, you're always allowed to take 80% of a value as a quick sale value, because they understand there's transaction costs. And so there's something right there I would wonder. Okay, well, you have this real estate. Okay, well, what's its real value? So, John, could you shed any insight on that? Have you? I'm sure you've given some thought.
Why don't we at this point? I think it'd be good just to go through step by step. Okay, how this thing works on the most basic level. Okay, so we started with, let's imagine the Schedule J is correct, even though we know it's not. Okay, we'll use that as the starting point to get some number. Let's say $1 million. Now, the next step is this: that we have to know of that $1 million, how much is going to be allocated to cash or cash equivalents, and how much is going to be allocated to fixed assets. The reason is that fixed assets are subject to a transition tax rate that's about half what cash is. Now, the rules are not simple, okay, in terms of how to make that calculation. The general presumption is that, so remember that undistributed earnings would not reflect necessarily the market value of it, because if you had $1 million in undistributed cash, and let's say you invest that in the stock market and it's worth $5 million, it would still show up as $1 million of undistributed earnings. It's just that it's worth more. Now, in order to calculate of that million how much is to be treated as cash, you have to look at the fair market value of some of the assets, et cetera, et cetera. But the bottom line is you start with $1 million and you decide how much is cash and how much is fixed assets. Then what happens, before including that in income, or for it becoming taxable income, you reduce some of that $1 million. The idea being presumably that you wouldn't necessarily have brought it back to the United States anyway. Now, the amounts that you reduce for taxable purposes are higher for fixed assets than they are for cash assets. So in other words, if you're using a Canadian-controlled private corporation as a private pension plan, as many people do, you're going to pay a much higher tax than somebody who's using a Canadian-controlled private corporation to hold, for example, a piece of land. Roughly what you're doing is you're going to reduce 45% of the cash, include the 55% in income. You're going to reduce, I think, about 75% of the value of the fixed asset, include the rest in income. Then once you've got it moved over in income, it's what's called a Subpart F inclusion. You're going to simply add it to ordinary income, and you're going to calculate a tax. Now, the question is, how would you then pay the tax? You can pay it if you want, okay, but people would first look to tax credits. So if you have any tax credit carryovers, let's imagine that we have a $300,000 tax bill, okay? Let's imagine that we have $100,000 of tax credit carryovers, so you could pay $300 of it with that $100,000 carryover. Then we're going to look at other possible credits, for example, in the year in 2017. Perhaps you made a distribution from the company during that year that generated foreign taxes payable, then that could perhaps be used as a credit as well. So that's basically how you would run through the thing. There's a second way of running through the thing. It's called a 962 election, where it's extremely complicated, but in general what you're doing is you're saying, hey, this is insane. Why would I be taxed on this amount of money when my Canadian corporation's already paid tax on it? And yes, there are provisions to use the tax paid by the Canadian corporation against this to basically lower the amount owing. And it's a very specific facts and circumstances for any individual. But in a sense, that's how you run the numbers and how you get through it. Now, we were talking about the June 15th date, and this is extremely important because the reason that deadline is important is because if the tax owing, whatever it is, however it's calculated, is paid by June 15th, you have the right to, or rather, if you respond to this by June 15th, you have the right to elect to pay the tax owing over 8 years. It's not a tax liability in 8 years. It's a tax liability in 1 year that can be paid over 8 years. And that can obviously be very, very helpful to people who don't have any money to pay that. Now, in terms of responding to this thing, the pressure to respond to June 15th is precisely because if you don't respond by June the 15th, then you lose the right to pay the thing out over 8 years, and the full amount becomes due, which, obviously could be a tremendous disaster depending on how much is actually owing. Bottom line here is that anybody caught up in this has got to get help from somebody who's thought about this more than a few seconds, because you can't sort of read online and say, well, this is the best way for you to go or not, because it is so contextual. It is so specific to your circumstance. I mean, there's some people with small amounts of retained earnings and large foreign tax credit carryovers who are hardly affected by this at all. At the other extreme, we have people who've had 35 years of a company of, building a retirement asset that could have millions of dollars in this thing, obviously don't have enough tax credit carryovers to even begin to wipe that out. It could be paying millions or even tens of millions of dollars on this thing. Anyway, that's how it works. Anybody affected by this has got to get help in deciding how to respond and when to respond.
Yeah, I thank you so much, John. Agree that there's a lot of issues that pop up, and sometimes, and I think, David, I like your first inquiry. Well, what's your retained earnings? Before we get all crazy, what's your retained earnings? Is it negative? Okay, well, we can stop. You don't have anything to worry about. And then with the other issues, you want to, I think one of the things is before you go ahead and do this, you got to make sure your 5471s are correct, because the IRS. This is easy. Finding a mistake, a superficial mistake on a 5471 is easy for the IRS, and they're looking to do it because it's a $10,000 penalty per occurrence, and typically you have many years. And if it's not filed at all, the IRS has forever to do that, and the IRS can actually open an audit on the entire return. Now, David, my question for you is: have you heard of this? Has this transition tax increased the amount of people sort of muttering and saying, "Yeah, that's it. I'm going to renounce my U.S. citizenship"? Have you heard of anything like that?
I haven't yet, because I've been trying to get to the bottom of the issue before I've talked to all but my top, say, 3 clients.
Mm-hmm.
I really should have put something out on it long ago, but there's a lot of confusion.
Yes.
And until I don't want to increase the confusion. Your question is, are they talking about renouncing? Well, it doesn't fix this problem because it's too late.
Yeah.
Although I did have one of my clients accidentally renounce last June. I thought, thank God this doesn't apply to you. But you can't retroactively renounce and get yourself out of this problem. So this narrow issue, I don't believe is the renouncing problem, other than just super irritating or pushing them over that way. What will get them to renounce is the GILTI tax that is coming next year, and although it isn't a significant a dollar amount, it will be different. And that applies to next year, but that's really all part of this. This is a transition tax to the GILTI system, and we haven't brought up GILTI because that isn't the current problem, but that'll start next year.
Yeah, and I would just say this. I would say that, in order to renounce your citizenship, you have to be certified that you are in compliance with the IRS for the last 5 years. Now, there's a difference between filing everything and owing money. It depends on how you owe money. If you renounce citizenship and you owe this bill, I think there's a colorable claim that I can't pay it because it's in the assets are deployed. I don't have access to them. I believe you would be able to file, say, okay, well, I'm not going to pay, and you can renounce your citizenship owing the IRS money. What you have to be is into the compliance to your best of your ability, and so that might be something for some people to look into, just to say, well, I'll file it because I have to certify that I'm in compliance, but I just have no meaningful way to pay for it. And I'm hoping that some people in Congress are watching this and sort of paying attention to see what they're what's actually going to incur. You pass this rule. Good luck enforcing it. And also, just because someone owes a tax doesn't mean it gets paid. And that's something that CBL never takes into account, that never looks at actually what's received. It's always sort of, well, this is what's projected. And so it's an accounts receivable on the government counts as much as cash, from my understanding, unfortunately.
I don't think it's as long a term problem paying it. I say on the long term. If you can use the 8 years, see, they have earnings out there, but they don't necessarily have cash. So within 8 years, or it's not like it isn't a bankable situation, because if you've got $10 million of earnings out there, but no cash, you're going to come up with a number that you have to pay, but at the end of the day, you have at least profits of those $10 million.
You should.
So to say
Let's hope.
There's profits out there, but they may be sitting in inventory, in fixed assets, in one big thing that John didn't mention about the cash contribution or calculation, cash also is defined as those short-term loans that I know all my Canadians are doing, loaning money to the themselves, family members, other corporations in the family. So those short-term loans aren't actually cash, but they're treated as cash for the higher tax calculation.
Oh yeah.
So that's one that's been bothering me a lot, because I know that's where the cash is. It's out there in those short-term loans. Well, you got to get that back if you're going to pay the tax. And to say that it isn't collectible fully, I don't know how they're going to cross the border to get it. But if it was, if the borders were dropped, there's assets there. Otherwise, we wouldn't be talking. As John said, this is a tax on your actual assets, not anything else. It's just there was no taxable event to cause this tax.
Yeah, there wasn't a disposition, and that's what's really obnoxious about this. It's a transition tax, not technically an income tax, and I would just say, looking at the Glenshaw Glass, test for income, we seem to, because if it was an income tax, it seems to violate that. You didn't have the disposition. So I mean, maybe there will be some sort of challenge coming on that down the road, that you really didn't have a disposition. You created a phony one, and if you can create a phony one here, you can create a phony one for anything. There's nothing to stop. There's nothing to stop from turning the income tax on its head, and I think that's kind of what's been done here. You've taken a crazy system as it is and just turned it upside down and then you shook it up to make it a little bit crazier. So
this one of the asset confiscation now.
Yeah. You're great, John. I love your commentary. That's absolutely right. Yeah, you're right. Yeah.
I mean, let's at least describe what it is.
Yeah.
Not beat around the bush here.
Yeah, that's right. And it's hitting. It hits Americans abroad who are living abroad. Usually, from my experience, our clients overseas are in compliance with the tax laws of where they are. The only one they're not in is the one that's the most difficult to comply with, the one that has very little connection to do with how they make their money. That's the U.S. tax system. So I think we all can agree that this just really unfairly discriminates against the American abroad. And while giving a significant benefit, not that I have a problem with large corporations getting a benefit. I think it's a good idea that the money parked overseas that's not doing anything gets to work in America. I think that's a good idea, but it wasn't a situation where we needed to do this to punish individuals in order to allow that to happen.
Anthony,
I agree.
Let's perhaps consider from this point of view. I mean, I agree with what you're saying, but if somebody were listening to this, they might think that it impacts all individuals in the same way. This is actually beneficial for individuals who are homeland Americans and are not tax residents of other countries. Because let's look at it this way, okay? So they've got the earnings in these foreign corporations, and this particular transition tax, the first thing it does is that it allows them, okay, to actually pay a lower rate of tax than they would later, okay? And by the way, one thing we didn't mention, by the way, is that individuals will pay a higher rate of tax than corporations. It's 17.54% as opposed to 15.5%. It's truly incredible. I'll tell you again. Individuals pay a higher rate of tax at 17.54% than Apple Corporation at 15.5%. But what's interesting is this. Even at 17.54%, let's say we're looking at an individual in the United States, not subject to taxation anywhere else, that person, okay, is being offered the chance, or being forced, okay, to include these retained earnings and income, but pay a lower tax than they would have if they had taken it out over time. But understand this, that this pool of undistributed earnings that is subject to this tax, once it's been included in income, it will never be taxed by the United States again. Never. Okay, it becomes previously taxed earnings. So if we look at it again from the point of view of a homeland American, one, they get to pay tax on it at a lower rate than they would, okay, if they took it out later, and two, they're able to pay it over 8 years from money that's already been taxed, so they can actually withdraw it from the company over an 8-year period and not pay any tax at all. It's an unbelievably sweet deal. Now let's compare it to an American abroad, okay, who, yes, okay, all of this applies, still previously taxed earnings, but the problem is that this individual is subject to double taxation. So when this person takes the money out of the company and, say, in Canada, they're going to pay a tax in Canada, okay? They've already essentially paid the tax in the U.S., but because of the timing mismatches, there's no ability to use tax credits or anything like that. So from the point of view of an American abroad as a tax resident of another country who still has to pay tax on that money in the country where they reside, this is an out-and-out confiscation of 17.54% of the it's an out-and-out confiscation. So in other words, it destroys Americans abroad, and it's a real sweet deal for a homeland American. And this is, one of the problems here. And this is not the only example. I put together a list just off the top of my head over morning coffee of 12 situations where an American abroad is punished essentially for living abroad as opposed to a homeland American. It's an unbelievable situation. One other point, you were talking about the renunciations and that. I think it's important, Anthony, to understand that you do not have to be tax compliant to renounce U.S. citizenship. Most people judge it to be in their interest to do so, to not be subject to exit taxes, and because they want to, exit the system in all respects cleanly. But there is no legal requirement of being in tax compliance to renounce citizenship. And I think that this type of stuff absolutely is going to push people to renounce. And understand, it's not really the transition tax per se. It's what it represents. And it represents the result of a system where we have Congress making laws and they don't care about Americans abroad. But that's not even the biggest problem. It's not that Congress doesn't care about Americans abroad. It's that Congress doesn't even care that they don't care about Americans abroad. And for that reason, I think this transition tax and GILTI is only the beginning. My advice to these people, get out.
Yeah. Well, you bring up some points there. We have GILTI to talk about. David, thank you so much for being on today. I hope that you'll be a returning guest. I really appreciate your insight to this. And John, as always, you do fantastic work. And, I think you call it like it is. This is a confiscation. And it's really unfortunate that we have people who care not to care. And so, by the way, and I would say, we will probably be hitting some more on this 965 and the GILTI as we're going on. And this is something that I think most people don't understand is that, the people who are giving these orders, Congress gives all these orders to people who comply with the tax code. Well, I've been doing tax law for 15 years now, and I could tell you most people only comply. Most people, some people will. Most people only comply when they absolutely have to. That you could have somebody who owes the IRS millions of dollars who doesn't do anything about it and sort of avoids the problem. That's something that I've learned from people in action. Now, what the IRS is doing with all these more and more complicated laws is you're only encouraging the thing that you claim you don't want. That is continued noncompliance. And in our next episode, we're going to be speaking with a gentleman known as who's ill, and he's going to give his answers to say why he's going to say no to the IRS tax code and no to compliance, and he's going to continue on his merry old way. So I hope you join us for that, and so be sure to subscribe. And once again, I want to thank our guests, John Richardson and David Sutherland, for joining us today and really adding some incredibly valuable insight. I think these, there's probably not many more who know more about 965 than these gentlemen. Even though I don't think you guys are scheduling those CLEs, even though maybe you should. We really appreciate you joining. Again, this is Anthony Parent for IRS Medic, Parent and Parent LLP, and I thank you for watching.